What if I told you that your RRSP refund is not actually free money? Every year, Canadians get excited when they make an RRSP contribution and suddenly their tax refund gets bigger. And honestly, I get it. Seeing a bigger refund feels amazing. It feels like the CRA just sent you a little apology check for all the taxes you paid. But here is the part most people miss. An RRSP refund is not always a tax saving. Sometimes it is just a tax delay. And if you use the RRSP the wrong way, that refund can turn into a trap later. Because the real question is not how big is my refund today? The real question is how much tax will I pay later? Before we get into it, this video is for general educational information only. It is not personal financial, tax, legal, or investment advice. RRSPs can be very useful, but whether they make sense for you depends on your income, tax bracket, pension, future retirement income, province, and goals. Always check your CRA My account, your notice of assessment, and consider speaking with a qualified tax professional.
Let's start simple. When you contribute to an RRSP, you may be able to deduct that contribution from your income on your tax return. So if you earned $70,000 and contributed $5,000 to your RRSP, your taxable income may be calculated as if you earned $65,000 for that part of your return. That can reduce your tax bill and may increase your refund. That sounds great, but the money inside the RRSP has not escaped tax forever. It is usually taxed when you withdraw it later. So the refund is not the finish line. It is more like the CRA saying, "We'll talk later." Here is where the trap happens. A lot of people treat the RRSP refund like bonus money. They contribute to the RRSP, get a refund, and then spend the refund on a vacation, shopping, bills, or just regular life. No judgment. Life in Canada is expensive. But if you spend the refund, you may lose one of the biggest advantages of the RRSP strategy, because the RRSP works best when the tax refund is used wisely. For example, some people reinvest the refund, pay down high-interest debt, add it to a TFSA, or use it for another financial goal. But if the refund disappears into everyday spending, you still have the future tax bill waiting for you when you withdraw from the RRSP. This is why two Canadians can make the exact same RRSP contribution, but one builds wealth, and the other just delays taxes. Let's use a simple example. Imagine Priya earns $80,000 a year. She contributes $10,000 to her RRSP. Because of that deduction, she gets a bigger refund. Let's say her refund increases by about $3,000. This is just a simplified example, and the real amount depends on her province and tax situation. Now Priya has two choices. Choice 1, she spends the $3,000 refund. Choice 2, she invests the $3,000 refund, pays down expensive debt, or puts it toward another smart goal. In both cases, Priya still has $10,000 inside the RRSP. But in choice 2, she also kept the refund working for her. That is a very different outcome, because years later, when she withdraws from the RRSP, that withdrawal is generally taxable. So if she spent the refund years ago, she enjoyed the benefit up front, but may still face tax later. The RRSP refund is powerful, but only if you do not treat it like random money from Ottawa with maple syrup on top. Now, this does not mean RRSPs are bad. RRSPs can be excellent in the right situation. They may work especially well when you are in a higher tax bracket today and expect to be in a lower tax bracket when you withdraw the money later. They can also be useful if your employer offers RRSP matching. Employer matching is important because that is extra money going into your retirement savings.
Skipping a good match can be like leaving part of your compensation on the table. RRSPs can also help people who want to lower taxable income today, especially if that affects certain income-tested benefits or credits. But again, the key word is may. This depends on your personal situation. The RRSP is not the trap. Using it blindly is the trap. Now let's talk about when RRSPs may not be the best first choice. If your income is low right now, your tax rate may also be lower. That means your RRSP deduction may not give you a huge refund today. And if you withdraw the money later when your income is higher, you might pay tax at a higher rate later than the rate you saved today. That is not always ideal. This is one reason some Canadians compare RRSPs with TFSAs.
With a TFSA, you do not get a deduction when you contribute, but qualified withdrawals are generally tax-free. So for some lower-income Canadians, younger workers, students, or people expecting higher income later, the TFSA may sometimes be more flexible. But again, it depends. The best account is not always the one with the biggest refund today. Sometimes it is the one that gives you the best after-tax result later. Here is another RRSP mistake Canadians make. They contribute because they want the refund, but they do not check their actual RRSP deduction limit first. Your RRSP room is not just a random number you guess. Your RRSP deduction limit is generally based on things like your earned income from the previous year, the annual RRSP limit, unused room from previous years, and adjustments such as pension amounts.
You can usually find your RRSP deduction limit on your Notice of Assessment, Notice of Reassessment, CRA My Account, or Form T1028 if CRA sends one. And this matters because over-contributing can create problems. In general, unused RRSP contributions above your deduction limit by more than $2,000 may be subject to a monthly penalty tax. So before making a contribution, check your actual room. Not vibes, not a guess, not what your friend at work said during lunch, your actual CRA number. Because nothing ruins RRSP season faster than finding out your tax-saving move created a penalty. Here is a better way to think about the RRSP refund.
Do not ask, how do I get the biggest refund? Ask, what is my plan for the refund? Because the refund is part of the strategy. For example, someone might use the refund to pay down high-interest debt, add to a TFSA, build an emergency fund, contribute more toward retirement, or save for a specific goal. The exact choice depends on the person. But the big idea is this. If the RRSP gives you a tax refund and you use that refund to strengthen your finances, the RRSP can become much more powerful. If the refund just disappears, the strategy becomes weaker. The refund is not the reward. The refund is a tool. Before making an RRSP contribution just to get a refund, check these 5 things.
First, check your RRSP deduction limit in CRA My Account or your Notice of Assessment. Second, think about your income today versus your expected income later. Third, compare RRSP versus TFSA for your situation. Fourth, check whether you have an employer match. Fifth, decide what you will do with the refund before it hits your bank account. That last one is huge, because money without a plan has a funny way of becoming takeout, subscriptions, and one quick Costco run that somehow turns into $287. So here is the simple takeaway. An RRSP refund is not bad. An RRSP is not bad. But an RRSP refund is not free money. It usually means you reduced tax today, but the money may be taxed later when you withdraw it. That can be a great deal if your tax rate is lower later, or if you use the refund wisely. But it can become a trap if you contribute only for the refund, spend the refund, ignore your RRSP room, or never think about future withdrawals. So before you chase a bigger refund, ask yourself this. Am I actually saving tax? Or am I just delaying tax? Because that one question can change how you use your RRSP. If you want a simple breakdown of RRSP versus TFSA, watch the next video, because that is where this decision gets really interesting. And comment below, when you get a tax refund, do you usually save it, invest it, pay debt, or spend it?